It is Tuesday, the 17th of February, 2026. The time is exactly midnight on Wall Street, and if you look closely at the charts, you can see the digital blood on the pavement. We aren't looking at a standard market correction. We are looking at a massacre of positions. I am your host, and you are watching Analysis with AG, and today we are performing a forensic autopsy on a market that has completely lost its mind. While the rest of the world is sleeping, someone just blew up. Someone very big. Someone with enough leverage to shake the foundations of the precious metals market. Gold is down $85 in a single session. Silver is hovering at $74.83. On the surface, the mainstream media will tell you that the inflation trade is over or that the fear is subsiding. They are lying to you. They are reading a script written by people who want your physical metal for pennies on the dollar. I have the spreadsheets open, I have the correlation logs pulled, and I can tell you with mathematical certainty that what happened today is not a fundamental repricing. It is a forced liquidation. It is the sound of the vault doors locking and the leverage being vaporized in real time. Look at the world around us. It is February 2026. U.S. aircraft carriers are currently deploying to active conflict zones. Geopolitical tension is at a decadal high. In any rational universe, this is the exact moment when gold should be going vertical. But it didn't. It went through the floor. Simultaneously, Treasury yields just collapsed to 4.03%. That is a massive bond rally. It means institutional money is terrified. It means they are fleeing into the perceived safety of government debt. Historically, when yields drop and war drums beat, gold and silver are the primary beneficiaries. That correlation has held firm for 50 years. It held during the oil shocks of the 70s. It held during the collapse of the Soviet Union. It held during the 2008 financial crisis. But today, the math stopped mathing. The machine broke. And when the machine breaks, it usually means the plumbing is backed up. The suits in their air-conditioned offices will tell you this isn't financial advice. They are right. This is a survival guide for a burning theater. If you still trust the people who told you inflation was transitory in 2021, if you still believe the regulators who said the banks were resilient in 2023, or the analysts who claimed the repo market was stable in 2024, then you are exactly where they want you. I'm just a guy with a stack of data and a bad case of insomnia, watching the great divorce between paper and physical reality happen in front of my eyes. This video is getting throttled as we speak. The 2026 shadow ban is real, and the post-censorship framework of YouTube is designed to bury anything that mentions liquidity cascades or correlation breakdowns. I need you to aggressively hit that like button. Not for my ego, but to feed the algorithm enough engagement to keep this truth from being memory holed. We are fighting a war against the narrative, and your engagement is the only ammunition we have left. Let's look at the crime scene. We have a weapon, a victim, and a suspect. The weapon is leverage. The victim is the retail investor who just got shaken out of their position. The suspect is a major hedge fund or a bullion bank that just hit a margin call they couldn't meet. To understand why gold dropped $85 while the world was falling apart, you have to understand the rule of the liquidity crisis. In a fire, you don't sell what you want to sell. You sell what you can sell. Gold and silver are the most liquid assets on the planet. The COMEX runs 23 hours a day. There is always a bid. When a fund gets a margin call at 3 in the morning because their equity portfolio or their currency hedge just blew up, they don't have time to wait for a buyer for their commercial real estate or their private equity stakes. They puke their gold. They dump their silver. They sell it not because they think it's overvalued, but because they need the cash to keep the lights on for another 24 hours. We have seen this movie before. This isn't speculation. It's history repeating itself with a 2026 twist. Think back to March 2020. The world was locking down. A pandemic was sweeping the globe. Fear was at an all-time high. Gold should have been a moonshot. Instead, from March 9th to March 16th, gold dropped from $1,700 down to $1,480. Silver got absolutely annihilated, falling from $17 to $12 in a single week. A 30% haircut during the greatest crisis of the decade. Why? Because the smart money was leveraged to the hilt in the stock market. When the S&P 500 started hitting circuit breakers, the margin calls went out. The hedge funds had to sell their gold to cover their losses in Tesla and Apple. But look at what happened next. By August of that same year, gold was at $2,100 and silver was at $29. The forced selling created the greatest buying opportunity of a generation. The same thing happened in September 2011 during the Eurozone debt crisis. Greece was imploding. The contagion risk was everywhere. Gold hit $1,900. And then, out of nowhere, it dropped $300 in 3 weeks. The fundamentals didn't change. The debt didn't go away. But the European banks were long gold, and they were desperate for capital. They sold what they could. They puked the metal. By 2012, the fundamentals reasserted themselves. We saw it again in October 2008. Lehman Brothers had just collapsed. The financial system was in cardiac arrest. Gold should have been $10,000. Instead, it dropped from $1,000 down to $730 in 2 months. It was the same story: redemption requests, margin calls, and forced liquidations. Liquidity crises do not follow fundamental logic. They follow the cold, hard logic of the margin clerk. And that is exactly what we are seeing today, February 17, 2026. The statistical probability of gold dropping $85 while Treasury yields fall 15 basis points and aircraft carriers are moving is less than 0.01%. It is a 3 standard deviation event. It is a black swan that was manufactured by excessive leverage. Gold's correlation to the 10-year yield has been negative 0.6 for the last decade. When yields drop, gold rises. Today, yields drop 15 basis points. That should have equated to a $15 move higher in gold. Instead, we got an $85 move lower. That is a $100 deviation from the expected math. This isn't a market, it's a crime scene. If you're finding clarity in this mess while everyone else is panicking, consider hitting the super thanks button. This channel doesn't have corporate sponsors. We don't have a desk at a bullion bank. We rely on the community to keep the data subscriptions active so I can continue to pull these correlations and show you the rust in the plumbing. Every dollar goes directly into the forensics that the mainstream media refuses to do. They want you to think the price is the value. I'm here to show you that the price is just a temporary reflection of someone else's desperation. Now, let's talk about the suspect. Who blew up? There are 3 likely scenarios. Scenario 1. A macro hedge fund had a massive long position in long-dated Treasury bonds. Now, you might think they'd be happy today because bonds rallied. But if they were using that bond position as collateral to short the Japanese yen or to a long on high-growth tech stocks that are currently cratering, the gains in the bonds weren't enough to offset the losses elsewhere. When the volatility spiked, their value-at-risk models started screaming. Their prime broker called. They needed cash by the London Open. So they sold their gold futures. They sold their silver. They puked the most liquid part of their portfolio to save the rest of the ship. The price of gold today isn't a reflection of gold. It's a reflection of that fund's leverage. Scenario 2 involves the bullion banks themselves. These are the market makers. They sell physical metal to the public and they hedge that exposure by shorting the futures market. If the physical market suddenly saw a massive surge in demand due to the geopolitical news, the banks would find themselves offside. To balance their books, they might be forced into a mechanical unwind that creates a downward cascade in the paper price. It's a feedback loop that has nothing to do with the metal in the vault and everything to do with the math on the screen. Scenario 3 is the most concerning. It's the sovereign wealth fund scenario. We are in 2026. The BRICS nations are actively moving away from the dollar, but many of these nations still have massive dollar-denominated debt obligations. If a central bank in an emerging market needed to defend its currency today, they would need dollars. Fast. And the quickest way to get dollars when the repo market is tight is to sell your gold reserves. We saw a version of this during the 2022 UK gilt crisis. Even the most sophisticated institutions can find themselves in a liquidity trap where they are forced to sell the one thing they actually want to keep. All 3 scenarios lead to the same conclusion. The selling is mechanical, not analytical. It is not a bearish forecast for the future of precious metals. It is a forced exit. And here is the secret that Wall Street doesn't want you to know. Forced liquidations are temporary. Fundamental drivers are permanent. The geopolitical risk that spiked today didn't go away just because gold is $85 cheaper. The bond market fear trade that sent yields to 4.03% didn't evaporate. The fiscal deficit of the United States, which is currently running at $2 trillion a year, didn't magically resolve itself. The debt-to-GDP ratio is still 125%. The interest expense on the national debt is still over $1 trillion annually. All of the reasons you bought gold and silver in the first place are not only still there, they are getting worse. Let's look at the silver math, because that's where the real opportunity is hidden. Silver is sitting at $74.83. To the average person, that looks like a crash. To a truth teller, it looks like a gift. As of February 2026, The M2 money supply in the United States is roughly $21 trillion. The total above-ground silver inventory, the stuff that isn't sitting in a landfill or a circuit board, is roughly 2 billion ounces. If we just did a simple division, the silver-to-money supply ratio is over $10,000 per ounce. Now, I'm not saying silver is going to 10,000 tomorrow, but let's be conservative. If silver just reclaimed its historical role of representing a mere 1% of the broad money supply, we are looking at a price of $105 per ounce. We are at 74. We are $30 below a conservative mean reversion. And that doesn't even account for the industrial side. We are in the middle of the 2026 green energy transition. Silver demand for photovoltaics and electric vehicle components is at an all-time high. The annual mine supply is struggling to stay at 1 billion ounces. The entire global silver market, physical and paper combined, is smaller than the market cap of a single large-cap tech company. It is a tiny, tiny pond. When an institutional whale is forced to puke their position, they don't just create a ripple, they create a tsunami. But because the pond is so small, once that seller is gone, the recovery is equally violent. This is why I track the plumbing. This is why I look at the volume spikes. If you want to know when the selling is exhausted, you have to look at the COMEX intraday data. Forced liquidations show up as massive volume spikes that occur in a vacuum. And local selling is slow. It's a steady bleed over days or weeks. Today was a vertical drop on huge volume. That is the hallmark of a margin call. If you want to see the follow-up analysis where I identify the exact moment the selling pressure is exhausted, make sure you are subscribed. This isn't clickbait. This is literally tracking the settlement data to find the entry point. The people who bought the March 2020 bottom made 140% on silver in 4 months. I'm not saying we repeat that exact percentage, but the structure of the move is identical. Let's talk about the villain of 2026, leverage in the repo market. The entire financial system is built on borrowed money. You have a Treasury bond worth $1 million. You pledge it as collateral, and a dealer gives you $990,000 in cash. You use that cash to buy more bonds or more gold. It's a great game until the value of the collateral starts swinging. In 2026, the 10-year yield moving 15 basis points in a day is the equivalent of an earthquake. When yields swing that hard, the haircuts on collateral go up. Suddenly, your dealer only wants to lend you $900,000 against that same $1 million bond. That $100,000 gap is your margin call. And if you have 1,000 of those positions, you need $100 million by the end of the day. Where do you get it? You sell your gold. You sell your silver. You sell the only things that still have a bid. This is why the 2025 bank shocks were so critical. We saw regional banks getting absorbed because their bond portfolios were being eaten alive by rate volatility. We saw the regulators scrambling to hide the mark-to-market losses. But you can't hide them forever. Today's gold crash is the tell. It's the market admitting that someone, somewhere, just ran out of time. They hit the wall. And the gold they dumped is now being picked up by the people who understand the long game. Who is picking it up? The BRICS. While a hedge fund in Greenwich is puking its paper gold contracts, the People's Bank of China is smiling. As of February 2026, China has reported gold reserve increases for 17 consecutive months. Their official reserves are over 2,300 tons, but the real number, the one based on Swiss and Hong Kong import data, is likely triple that. China isn't buying paper contracts on the COMEX. They're buying physical bars and vaulting them in Shanghai. They're preparing for the great reset of the international monetary system. They know that the dollar's status as the global reserve currency is on a timer. The US debt is a runaway train, and gold is the only exit ramp. The fact that gold got cheaper today is a gift to the central banks of the East. They don't care about the $85 drop. They care about the tonnage. They are trading depreciating fiat currency for an asset that has no counterparty risk. Gold is the only asset that isn't someone else's liability. If you own a treasury, you are relying on the US government's ability to tax its citizens to pay you back. If you own a corporate bond, you are relying on a company's future earnings. If you own physical gold, you are relying on the laws of physics and 4,000 years of human history. This brings us to the great divorce. If you go to a major online dealer right now, you will see a strange phenomenon. The spot price of silver says $74, but the price of a silver eagle is $85. That is a $10 premium. That is not normal. In a healthy market, premiums are $2 or $3. A $10 premium means the physical market is laughing at the paper market. It means the people who actually want the metal are refusing to sell it at the official price. The COMEX is a paper game played by banks and speculators. The physical market is the real world. We saw this in 2020. Silver spot went to $12, but you couldn't find a coin for less than 20. The paper price was a lie. And the same lie is being told today. If you wait for the spot price to confirm a bottom, you are going to miss the boat. By the time the paper price recovers, the physical premiums will have exploded and the dealers will be out of stock. I'm already seeing inventory levels dropping at the major wholesalers. I'm seeing allocation-only notices on gold buffaloes. The physical market is tightening even as the paper price is falling. This is the ultimate disconnect. It is the snapback waiting to happen. I want to crowdsource some data. I need you to go to your local coin shop or check your favorite online dealer right now. What are you seeing for premiums? Are they widening? Are they holding firm? Drop a comment with the specific premium you're being quoted for silver and gold. We need to map out the physical tightness across the country because the dealers aren't going to tell us the truth, but the truth tellers in this community will. This is actionable intelligence that helps us see the bottom before the charts do. The mainstream media will spend the next 48 hours explaining why gold is dead. They will show you charts of the dollar index and talk about higher for longer interest rates. They will ignore the aircraft carriers. They will ignore the collapsing yields. They will ignore the fact that the repo market is screaming for help. They want you to be afraid. They want you to sell your physical metal so the bullion banks can cover their shorts. Don't give it to them. Understand the mechanics of the doom loop. The US government needs to print $2 trillion a year just to keep the lights on. To do that, they need people to buy treasuries. But if inflation is running at 3 or 4% and the BRICS are dumping treasuries, yields have to stay high to attract buyers. But if yields stay high, the interest on the debt explodes, which requires more printing. It's a circle that can only be broken by a massive devaluation of the currency or a return to a hard asset standard. Gold and silver are the insurance policies against that inevitable conclusion. Today's move was a push. It wasn't a fall. The market was pushed lower by a forced seller who had no choice. And when a price is pushed away from its fundamental value by a mechanical force, it eventually snaps back with an equal and opposite reaction. The fundamentals say gold should be $2,700 and silver should be $90. The fact that we are currently below those levels is a market inefficiency caused by leverage. And in the world of finance, inefficiencies are where the money is made. I am positioned for the snapback. I am buying this liquidation, not with leverage, not with futures, but with physical metal that I can hold in my hand. I am watching the Shanghai premiums. I am watching the COMEX delivery notices. And I am watching the truth tellers who are brave enough to see through the narrative. If you want the deep dive data, the spreadsheets, and the repo market mechanics that are too technical for the main channel, make sure you follow the secondary channel and the featured section. We are hitting them from both sides. They can try to shadow ban one, but they can't stop the truth from leaking out. This is a war for your wealth. The algorithm wants to bury this. The suits want you to panic. The banks want your metal. But you have the data. You have the history. You know that March 2020, September 2011, and October 2008 were the best times to buy, not the best times to sell. History doesn't repeat, but it rhymes. And right now the song it's singing is liquidation. The forced sellers are almost done. The margin calls are being settled. And when the dust clears, the only thing left will be the fundamentals. And the fundamentals are screaming. Stay frosty. Watch the premiums. Don't let the paper price dictate your reality. The great divorce is here, and the physical market is going to win. I'll see you in the next one when we track the recovery. This is Analysis with AG. The truth is in the plumbing. Don't stop looking.